following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and indeed a profitable trading week. My name is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network, and we're giving you a double dose of Volatility Views this week. We were off for a week, and now you get two shows in the span of 1 week, so twice the goodness for all of our Volatility Views fans out there. Of course, I'm not alone here on the Volatility Views panel, not by a long shot. I am joined by my boon companion, none other than Don Schlesinger of the Volatility Exchange. Don, welcome back to the show, sir.
Happy to be here as always.
All right. And of course, we are also joined by our volatility pit reporter, none other than Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the program as well.
Oh, thank you. I'm happy to be here. You know, I've had probably the second or third person come up to me and say, "Is there a volatility-based podcast that you don't do?" And I
wait till we launch even more.
Volatility.
An option block is not pure volatility, so it is other things.
Well, it really is. So, hey, Don, did you get a chance to see the VIX thing, Jim Cramer? I mean, there's a couple of small errors because he's not as familiar with VIX, but I would love to have seen what you thought of my analysis that I wrote up for him.
No, I haven't seen it, so you'll have to point me in the right direction.
Yeah, here, I'll send you the link. I'm sure I can take up 9 minutes of recording space if need be, but
yeah. But I thought it was funny because he was obviously reading from what someone had prepared for him on it. Yeah. It wasn't a topic he was very conversant on.
No, but the only part that he didn't read on was where he made an error, where he said the VIX has a range of 0 to 100. Now, it hasn't gotten over 100, although they say statistically that, you know, at Don, what did they say that a theoretical VIX would have been in 1987?
Well, I know that implieds went to 100 on that day. I don't think they lasted a very long time, but I tell the story in our conferences how the track data terminals gave implied volatilities to only two places because there never was such a thing on anything as 100 implied. And on that day, there were asterisks in the spot where implied volatility should be, just 2 stars. And the reason was that the implieds were over 100 and it blew up the machine because they weren't able to list it. And I go on to tell them about the day that Nadia Comaneci in the Montreal Olympics got the first perfect 10 in the history of gymnastics. And when they went to post the score, they only had 2 places because you would get a 9.8 or a 9.9. And they posted it as 1.0 because there was no room on the board for the third place. And everybody looked at the 1.0 and there was dead silence in the hall and nobody understood what was going on. And what was going on was that she had just gotten the first perfect 10 in Olympic history, but they had no way to post it. And that's what happened with track data. We had the first 100 volatility in the history of options and they had no way to post it.
See, I'd always knew there was a crossover between Olympic gymnastics and implied volatility. And here on Vol Views, we have indeed found that nexus.
You don't know Don's other nickname. It's
Don Perfect 10.
Don. I don't know if you knew that.
Perfect 10 Schlesinger. I thought it was sold to you, but we can add Perfect 10. I like it. All right, and with the introductions out of the way, we will, of course, be joined by a special guest in the Volatility Viewpoint segment, but now we're going to dive right into our Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the program where we dive into the world of volatility and the volatility action that we saw over the past week. And it was indeed quite the active week for volatility, particularly in terms of the old VIX cash that we like to look at on a regular basis here on the program. It's been vacillating around that 30 handle. As we record it today, it is back below the 30 handle by about 3 handles. It's about 27.5 right now, down about 10% today as we record this on mid-afternoon here on a Friday. So yes, the VIX has been once again up and down all around that 30 handle. And we've discussed several times throughout the week exactly what that means for traders and what we've been seeing and why the VIX has remained elevated for so long, and if it indeed will be time for the VIX to finally begin its slow descent down to perhaps a more normal and perhaps a more fitting range given the activity we've been seeing in the broad markets lately. And Mr. Sebastian, would you concur with that it is time for perhaps the VIX to begin to settle?
I think we're definitely seeing that. Believe it or not, looking at the VIX today, we're lower now. Even if the VIX itself isn't lower, and this is where you have to take it in relative terms.
That context we're always talking about.
I know. Take it in context, folks. VIX here is actually lower than where it was on Monday when it was trading at about the same level. Yesterday, one of the interesting things, at-the-money volatility didn't increase at all yesterday. It had actually increased all week. So when we made that move, almost everybody was, all that had been priced in. Don, have you ever heard of, can a market be fully hedged and thus vol does not react to any kind of movement? Because the way there was no volume in VIX options and VIX futures yesterday, vol didn't move, and yet the market was off 26 handles. Is that a sign of a fully hedged market? Well,
I'm not saying that I'm right about this, but it's just.
But I'm saying I'm right.
Well, I'm really just wondering. It simply occurred to me that yesterday was a 2% move, and we've just had so many of these, and it's an environment where, today we look at the Dow up 150 now, S&P up 18 or whatever. It's not quite 2%, so like 1.5 or so. And it's commonplace. It happens every day. And at some point, if that's going to be the environment, and I'm not saying that it is, you're going to have these 2% moves, if not only, on a daily basis, then certainly very frequently. And VIX shouldn't go anywhere, because if it's going to hover around 28 to 32 all the time, then that's exactly what kind of daily movement it indicates.
Exactly right, Don.
Either you're right. Either you're right, and eventually the market isn't going to be moving like this every day, and will return to a volatility regime, which we know has been very different in the past. Or this is the new norm for some time to come, and obviously it's been prevailing for a very long time already. And if that's the case, sooner or later people are just going to get bored with it.
If there is a new volatility regime, I would really, really like you to head up that regime. I want you to be the king. I would like you to be the sultan of the new volatility regime.
But the grand viceroy of volatility.
It's not a profound statement, but it's just something that I've been thinking for some time now. And that simply is that, if this is where we are and have been for quite some time, then people just aren't going to get all that excited about 2% moves. And so it wouldn't really surprise me that you don't see too much of anything with VIX movement on those types of days, because that's what 30 and 32 means.
It's funny you mentioned the fully hedged concept, because I had a similar idea last week going into this week as we watched, you're right, the VIX not really responding to a lot of movements and just the net unit buying activity we had seen in the downside in the SPX for so long going into the past week or so, that it did kind of leave me with a similar impression that perhaps people had put on their insurance now. They had put on their near-term risk management, and so the near-term vacillations weren't exactly causing a lot of consternation for them anymore. So I had a similar thought. And of course, Don's right that we are at levels where we should be doing, 2% plus every day. So this is kind of the norm anyway. So I think maybe it's a combination of the two. But I think there is something to be said for that, to the fact that we saw so much net unit downside buying over the past few weeks that I think a lot of people just, took their risk off the table, and now they can kind of sit back and have a little bit more freedom.
And think about, we were way below volume norms in VIX options and VIX futures yesterday on a day where we were down over 2%. So
Larry McMillan was on last week, and he talked a little bit about seasonality of VIX and of volatility. I don't know how much there is in the equity markets. Certainly it can be in commodities, but it's true. We're coming to year end. And maybe portfolio managers and hedge funds take a little risk off the table, lock in whatever profits they may have everything set up for the next 3 weeks. And, you're not going to see a lot of new types of positions put on in that situation.
We're in the Xmas doldrums there, you're saying.
Yeah.
Well, of course, we also cover the broad spectrum of vol and vol products here on the old Volatility Review, including the ever-intriguing world of Euro volatility. And so, Don, what have you been seeing over the past week in our good old Euro VoContracts?
Well, interestingly enough, it actually has trended somewhat lower. Today is an expiration day, and actually a quarterly expiration day as well. So we have the front 1 month going out, and we have the 3 month December 3 vol expiring as well. And earlier in the week on Monday, I had mentioned predicting somewhere in the 1240 to 1275 range. We actually have that partial volatility, which is all but today, the last day, at 1126, and the contract settled a few ticks higher at 1141. It looks like we're going to go out in that 11 handle, which, if we've been following the past several months, that's rather low. December looks like it goes out around 1294 or 1295. So, if anything, somewhat of a drop-off in this past week, despite all the news that continues to come out of Europe.
That is interesting, but of course we did see a little bit of a breather yesterday as people started to think maybe they have a chance to get their house in order over there in the Eurozone. So obviously that was reflected in the vol contracts. But it always, we talk about it a lot on the show, and it is always interesting to see just how much even a contract with so much of its lifespan already behind it and just a few days to go until expiration can still have some interesting developments, some interesting movements even in the final day or two or the final session or two of its lifespan.
Well, that's certainly true, and we've been pointing that out to people. If we were in the mid-12s and now at about 1126 to 40 or so, that's a full point on 12, or a little bit more than 8%. It's an 8% move in 3 or 4 days, and that's considerable for a contract.
All right, and that is going to do it for our Volatility Review segment, and now we're going to roll right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint segment. This is, of course, the portion of the show where Don, Mark, and myself grabbed some poor, unfortunate soul and forced him to sit down and answer our questions, usually in the glare of some very hot lights. Today's willing victim is Chris Cole. He is the managing director over at Artimus Capital Management. Chris, welcome to the program.
Thank you. It's great to be here.
And now, Chris, like we do with all of our first-time guests, why don't you give our listeners a little bit of an overview of your background particularly when it comes to derivatives, as well as an overview of what you guys do over at Artimus?
Sure. Artimus is a private investment partnership, and we specialize in quantitative volatility trading. And there's a specific focus on VIX futures and options. And we'll be launching a new fund this January that will essentially seek to provide long volatility exposure, but still generate returns in more static vol environments. I also do a lot of writing and research on volatility and lectures. I'll be speaking at Global Derivatives this April in Barcelona, which should be a lot of fun. And I really do enjoy to write and to kind of express some viewpoints out there on volatility and the VIX and macroeconomic themes in general.
So I noticed the mantra for Artimus Capital Management is to generate alpha through use of volatility. So you mentioned your use of VIX options and futures. Is that the sole instrument that you guys really spend the bulk of your time trading, or do you use maybe some underlying and incorporate VIX options into them in some way, shape, or form, or what is the main approach over at Artimus?
I think the main approach is really, to approach volatility the way that a lot of commodity pool operators approach different commodity futures. So in the concept of a quantitative and systematic framework where you're building models to exploit either the tendencies of pure volatility movement or to exploit changes across volatility services and volatility curves. So it's very much a purely vol-focused approach, which is, I think, relatively unique because I think a lot of people are using options or using volatility to augment, perhaps more traditional kind of investment theses. So we are a pure vol shop in that sense.
Chris, if I may ask a question, you spoke about the fund that you're going to open in January that was predominantly going to give exposure to long volatility, but then you mentioned that you'd like to be able to generate some positive returns even in a static environment. I don't know if it's proprietary in nature that you can't discuss, but I'm just curious that if you do have the doldrums or that lull or the static environment and you have an overriding long exposure to volatility, what kind of things you plan to do in order to generate positive returns in the slower environment?
Well, without going into specifics, in relation to the fund, because it is kind of a private investment pool, but more along the lines of the philosophy of what Artimus is seeking to do. I look at volatility term structures, and
right.
You look for example the VIX term structure, and really what you have is the market's expectation as to where volatility will be in the future. People look at the VIX futures, and what you're not seeing is a measurement of spot volatility necessarily, as much as you are a kind of option component that reflects the market's expectation of where vol will be at some point in the future. Similar to maybe a 1 month forward starting variance swap without a kind of convexity element there. Well, if you can look at that and you can pull out the market's measurement of implied volatility of volatility, essentially what is the implied volatility of volatility that's being reflected in that particular VIX future, and you can look for points across VIX futures curves and across volatility markets where volatility is structurally cheap or rich, and then look to, in essence, arbitrage out volatility inefficiencies. So really, in many ways, you're looking to structure positions to have a net long Vega bias, but you're looking for structural weak and strong points within VIX futures and options that can provide alpha in more static environments on a little bit of a neutral basis. So I hope that provides a little bit of color.
Yeah. So sort of just I'm not going to press you too much, but so are you talking about using things like kind of the natural in a low vol environment, kind of the VIX term structure curve kind of to your advantage, using things like the fact that kind of long options can have a long theta almost in VIX options sometimes. Different types of combinations of those type of plays to create your alpha in the low environment, and then set up so that if vol blows up, you're still kind of net long a weighted vega. Is that kind of about right?
That's exactly correct. Yeah, that's exactly the concept. And I think you can look at that and have situations where, in some of my research, I wrote a piece called, Is Volatility Broken? That described the period over quantitative easing 2, where the vol term structure became exceptionally steep. So what we saw is actually a tremendous amount of volatility, or expected volatility of volatility, being built into the back of the term structure that incorporated some of that steepness. And that was because you had a lot of not only retail investors who were looking to hedge, but also institutional investors who were scared about what was going to come after QE2. So that people began bidding up variance swaps in the back of the term structure, bidding up that long end of the term structure, particularly after the flash crash. And there weren't as many suppliers. So as a result, vol of vol, sort of a second derivative on a derivative, became very expensive on the back of the term structure. And that presents opportunities to play against other parts of the term structure. So these are the types of opportunities we look for to maybe generate alpha in more normalized volatility environments, while at the same time looking to always kind of be long convexity and be long vega to take advantage of those periods where the VIX explodes and that excess kurtosis is realized in the tails of the distribution.
Chris, if I understand correctly, you're mostly dealing with purely VIX products as opposed to anything having to do with the actual or the realized volatility, whether it be a realized volatility instrument such as the kind that we're bringing to the marketplace, or options straddles, or variance or volatility swaps. So basically, you're playing the kinds of things that you just mentioned, the steepness, the vol of vol, the contango, and what have you. It doesn't really matter where realized volatility goes and whether VIX as a prediction is right or wrong, or if realized accommodates the VIX predictions. You're just trading pure VIX the whole time?
That's right, a pure model-free approach. Although, it certainly is interesting to kind of, as some of these additional products come online that are exchange-traded, obviously that traditional relationship between implied and realized and that arbitrage. But my firm, what my firm really likes to focus on is it's almost the game theory expectation of, you look at VIX and, it's a forward-looking measurement, and you look at the futures or 1 month forward starting variance swaps for the futures on VIX, kind of as a proxy for one another. And those represent almost the expectation of where vol will be in the future. It's a psychology. And it's
Absolutely.
The game theory of playing that psychology, which I find actually just fascinating. And I think maybe is underrepresented or a lot of people are less inclined to pay attention to. Than some of the other more traditional kind of volatility plays that are more normal in the marketplace.
Well, I think you're right. I think the whole concept of VIX is not so much predicting what future volatility will be, but predicting what the prediction will be. You've got a pool
Absolutely.
of people, your pool of people who are options traders, and they're trading options at levels that reflect some sort of viewpoint or forecast of future volatility. But in the long run, as you just mentioned, it doesn't really matter whether volatility actually accommodates that forecast. It only matters what the futures settle at and what the new forecast is going to be, and how well you forecasted what a pool of people were going to be guessing a month from now.
That's exactly right. And what's even more fascinating about it is, in this kind of world where we have such major, we are all macroeconomic investors right now, whether we want to be or not. We are all macroeconomic traders, because what happens, with the EU or what happens with the Fed is driving markets today. And those expectations are being embedded in that forward volatility. And it's fascinating to see how those perceptions are changing. So to me, I wouldn't call myself I would not call myself a guy who sits around, making macro bets. That's not kind of my role. But to me, I think it's more than just pure numbers. It's more than the VIX at 80 or the VIX at 25. It's I think what you see is a set of embedded macroeconomic expectations and fear and greed that's being processed through these vol curves that become very fascinating and maybe can provide, even if you're not a vol trader, paying attention to these things can inform a fundamental thesis on where markets will move in the future as well.
So, it's just neat stuff. So just to get out of the theoretical and into the practical, what do you think about what's going on today? Kind of an interesting day, and I think a really interesting kind of discussion of how the VIX has behaved over the last couple of days. You have any thoughts on kind of VIX behavior since Monday?
Well, I see a term structure that is exceptionally flat right now.
Oh, crazy flat. Except for December.
And, exactly. And I think you see a lot of, really what that means is that there's not a lot of implied volatility being built in across the curve right now. So I think the vol market it's a little bit maybe stuck in neutral right now, trying to understand which direction this is going to go, because you have two scenarios here. We're going to go into a global depression and a deflationary event similar to 2008, which would pertain to much higher volatility and a crash in equity markets, or we're going to go into a situation where I think they've pretty much, in my mind, kind of made it clear or telegraphed that quantitative easing 3 is on the horizon. And when you have this excessive monetary stimulus, you have a situation where it tends to depress volatility. The period between QE2 and the announcement of QE2 in August leading up to April, that rolling period had one of the highest Sharpe ratios in the history of the S&P 500. And that's largely because the volatility component of that Sharpe ratio was so low. So you look at this, and I think the confusion or the flat vol term structure reflects this confusion between these two dualities in the market right now. And it's really a political guessing game right now. And I don't think the vol market's giving us any indication one way or the other as to where things might go. It's really interesting. When I look at it too, we have this flat term structure. We have exceptionally high implied and realized correlation. Shockingly high correlation levels that have reached higher levels than what we saw in 2008. But at the same time, we're trading oftentimes at a discount or at a slight premium, much lower than historical averages, to realized volatility. So, the VIX, looking at it as a forward measurement and looking at where realized volatility has come on in, the VIX has been consistently kind of flat to that measurement. So it's a very, I think, a confusing time right now, and I kind of feel like it's a little bit of the calm before the storm. But I tend to be a pessimist. So
you'll fit in very well on this program then with your pessimistic outlook. But you mentioned the VIX term structure, and it was very interesting indeed going into the QE2, and we've talked about it quite a bit on this show in recent months. How there's been a general trend to the overall VIX term structure where you'd see a overall preponderance of the paper flow and the expectation in the longer term months that VIX would eventually ease off the inflated levels that we had been seeing. But in the near term, it was elevated or it was just unched, or there was a preponderance of bets and no one really knew where VIX was going in the near term. And now you mentioned that the term structure has indeed flattened out quite a bit, showing that level of uncertainty has spread across the board to even the farther off months now, where we haven't seen as many people. The VIX has started to come off already a little bit, so some of the people who have been betting to the downside in VIX for quite a while are finally starting to take some of those bets off the table. But going forward, you're right, it is almost a bit of a coin flip where we go from here. So
yeah, for our retail traders, an interesting trade might be to short VXX or buy puts on VXX or sell calls on VXX, and then on a little bit of a ratio, not XVIX type where it's 1/2, but maybe 1/1.2, 1/1.3, go out and buy some VXZ for our retail traders. That'd be a really fun way to kind of play off all the different term structure issues.
And
yeah,
Mark Sebastian and I were discussing before you came on this very concept of somewhat of a pivot point, if you will, or a complacency where we get these 2% moves every day, and where VIX being 28, 30, 32 or so has more or less become the norm. And I think it's interesting when you have this flat type of curve where going farther out, you don't see very much of a difference between the near-term levels that, we all know that volatility eventually is a mean reverting instrument. And so when the near term is extremely high, usually look for backwardation and for the back months to be lower, because you can't sustain that high volatility for 6, 9, 12 months. And obviously when it's very low near term, which we haven't had much of lately, you look for the back months in contango to be higher, simply because reversion to the mean would indicate that that's the way you're going to go. I think if anything, the fact that we have this kind of equilibrium right now probably is saying that there's an awful lot of people out there who are starting to think that these levels are more or less what the mean really is, and that we don't have anywhere to go to revert to the mean, because they're accepting 28, 30 or so as what is being described as normal these days.
Yeah, that's a very telling observation. And I think people are stuck between these two paradigms, because, there's a tremendous amount of risk out there, because in any type of political headline can roll markets in one way or the other. So the term structure is very flat. And, for me to look at this and say, I'm playing off the dynamics of that term structure. I'm trying to always be a little bit net long Vega exposure. But so I'm a little bit less of a directional guy. It's interesting if you sat back and asked me, where's the VIX going to go tomorrow? I might have some opinions, but that's not how I try to make my money. But at the same time, when I look at this, I really feel that I would be a little bit cautious about going short volatility here, because I really feel like if you look at the term structure, you're not getting that much premium by going short vol. And at the same time, we're trading at levels that are, approximately on par with where realized volatility has been. Realized correlations are so high right now. And when correlations are high, that means that volatility is much more sensitive. So, we had the implied correlation index right now, the CBOE is in around 0.8. When correlation goes from 0.35 to 0.7 or 0.8, it's almost 50% more sensitive. So we have greater potential for large VIX movements, up or down for that matter. But to me, when you're looking at the excess kurtosis that's in VIX returns, when you're looking at the fact that you're not getting that much premium right now by going short volatility on a relationship between realized and implied, or also the vol-of-vol premium that's being built into the futures curve, to me, I feel like there's not enough bang to, or not enough premium to really being short the front of the curve right now, given the macroeconomic considerations. That, admittedly, is probably at odds with what a lot of other vol traders probably feel right now. So that's my viewpoint.
Chris, we see historically, when you look at historical implied volatilities and their relationship to realized, that in fact you do have such points as those now, where that traditional 4%, 3%, 5%, or percentage points premium of implied to realized simply isn't prevailing at the moment. I haven't done a lot of studies of it, but my recollection of looking at such graphs is that it doesn't really last a very long time before that traditional premium is restored. So I'm wondering if you've looked at previous periods where this kind of environment, where there seems to not be that traditional premium, were in fact the case going into history, and how that played out and what that might mean for trades that are setting up now in this type of environment.
Well, when I look at historical patterns, when you have a very low premium of implied to realized volatility, And then let's take a look at this from another standpoint. When you also have what would be, you look at the relationship between the volatility of implied volatility to the volatility of realized volatility. And that premium right now is also at the low end of the distribution. So when you have that kind of scenario, usually it's setting up it represents a lull period that can potentially result in explosions in vol later on. Although those kind of I'd call it a doldrum period. I was out sailing the other day with a guy who is a kind of hedge fund manager, and the wind kind of died down, and he sort of like, it kind of makes me feel like what the markets are right now. It's like you're in this doldrum period, but you know that the wind's going to come back, and you know it's going to be violent. And I feel that way with volatility right now. I mean, I think when you look at that relationship between the implied volatility premium and the volatility of volatility premium over realized vol, when you have that ratio on the low end of its historic extreme, then usually that ascertains a doldrum period that will eventually correct in a higher vol environment.
And here's a follow-up question. I'm sorry, Chris. Here's a follow-up question to that. Do you think it matters what the absolute level of volatility is when you have this situation? Would it matter to you in your prediction of higher volatility going forward because of this equilibrium, if this equilibrium were playing out at 16 or 14 or 18 vol as opposed to 30 or 32 vol? Is it harder to predict higher, let's say, realized volatility going forward when this equilibrium is established at 32 than it would be if it were at 14 or 16? In my view, I think it would be, but I'm not sure that you're necessarily saying that or that you agree with that.
No, you have a really good point about that, because I mean, I think when people look at when people say when have been the largest explosions in implied volatility, people would of course say like 2008, would be, and they wouldn't be wrong, but one of the largest increases in statistical and implied vol occurred, I think, in February of 2007, way before the crisis really.
Oh, that was a huge indicator that something was really wrong. That was the. Yeah. Are you talking about the Chinese economy missed? The Chinese GDP came up short, and we had the SPX drop about 50 handles, and the VIX was at like 12 at the time. That was an insane day. I think that was February 27th, 2007. Stop me if I'm wrong.
That's absolutely right. That was one of the largest increases in history.
That was nuts.
Yeah,
that was nuts.
It's funny because it occurred in a relatively tranquil environment. I mean, so when you look at that, I mean, when vol's down if you look at vol on a percentage basis, I think what you're saying is really correct in that sense. It's a lot harder to get that kind of a pop today. We'd have to go from 30 to 60, what would be the equivalent.
Right.
So it is something. I think if people are looking at tactical strike prices and in that kind of framework, it's just something to keep in mind. The potential on a percentage basis or standard deviation basis for extreme movements is much higher when we're in the teens than we are where we are today.
Right. All right. Last question, and then we'll stop putting you through the meat grinder here, Chris. And by the way, fascinating interview so far. We really appreciate you coming on. One of the things I've been actually kind of looking at is implied volatility of VIX options. Mm-hmm. And I've been kind of messing around, and I'd be interested to see if you've actually looked at this at all. Anecdotally, I've kind of seen implied volatility of the VIX options themselves as a bit of a leading indicator. Have you kind of looked at that at all? And am I telling tales outside of school, or is that something that would make some sense to you?
It actually does make some sense. It's something I've just started looking at. And I would say right now, based on my research, I haven't really come to any kind of conclusive points to that yet. But I think there's enough evidence there to say that it's worth paying attention to. And, I'm continuing to conduct studies on that, specifically with relation to the skew, in those options. And one of the things that I've been doing a lot of recently is actually, putting together a string of VIX options and producing essentially a variance swap strike rate on VIX options, and then using that as a forward indicator. And that becomes very interesting to sort of see and gauge fear in the marketplace. And to that extent, you have a kind of an embedded skew in that variance, that VIX variance strike rate. So I've been spending a lot of my time has been focused on skew and also kind of establishing variance swaps strikes on VIX options. As far as I've kind of been looking at it as an indication of, you look at it like a log contract and kind of see what the market's projection of high and low will be, and then extrapolate how correct that has been. And so that's kind of been the focus of my research. And I do think that there is something to what you're saying. Maybe 6 months down the road, I could have a little bit more to say about it because, my research on the subject is still kind of evolving. But is it worth paying attention to? I'd absolutely say it is. And especially as we get more liquidity in these products.
Well, Chris, I hate to cut this off because this is such a fascinating conversation. We could go on for quite a while, but we are coming to the tail end of the program here, and we still have one more segment to go. But before we go, I do want to give you a chance to mention to all of our listeners who are interested in your research and interested in perhaps participating in that new fund you mentioned, how they can go about doing that. So where should they go if they want to learn more about your research and your fund management and all the different things that they could get over at Artimus?
If you're interested in learning more about Artimus, you can contact me at on my website, www.artimuscm.com. And also, my research is widely available on the web. I've written 3 research papers recently: "Is Volatility Broken?" "The Great Vegas Short," and also "Fighting Fire with Fire," "Fighting Greek Fire with Fire." So those are available widely on the internet and across the blogosphere. So feel free to reference those, and if anyone's interested in learning more about Artimus, I'm available through the contact information on the website.
Well, Chris, thank you for coming on. It was indeed a fascinating discussion. We'll have to bring you on again down the road when you have the new fund launch. We could talk about some of your outlooks for volatility going forward at that point.
That'd be great, guys. Thank you very much. It's been a pleasure. It was a lot of fun.
Yeah, thank you.
Thanks, Chris. Great talking with you.
All right, and that is going to do it for our Volatility Viewpoint segment. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we prognosticate wildly about the future of volatility, and then we gaze into our crystal balls to see what the murky ether of the future has in store for the marketplace. And Mr. Sebas, I know we've discussed several times about your leanings here and what you think for VIX going forward. And actually, as our guest just mentioned in the previous segment, it is somewhat of a coin flip at this point with VIX right now. A lot of people have been leaning short VIX for a long time when VIX was elevated in the mid to high 30s. Now it's come off substantially. Now, as Don refers to, maybe we're at the mean right now. Maybe this is where we're going to be reverting to for the foreseeable future.
Yeah, I do think VIX has kind of 2 means going at any time, a near-term mean and a long-term mean. And eventually, and that long-term mean does kind of slowly pull VIX down. I'm seeing a slowing in realized volatility, a slowing in implied vol. I think that when we talk in February, we're going to be talking about a VIX that's well below 25, and 2012, at least the first half of 2012, may shape up a lot like 2009, or the second half of 2009 might shape up like the first half of 2012, where we just see kind of a sinking VIX. Not saying that we're out of the woods, but I would like to, I wouldn't want to be super. I wouldn't want to be long here. My leaning would be a little bit short with protection. So you still need those units.
Anything you do here, you got to have that. Yeah, you got to have the way like upside. That. You got to have net units for VIX right now for that pop, because in case the Eurozone implodes or any number of things could send us way back into the high 30s or 40s very easily.
I'm actually in the middle of developing a SPX VIX arbitrage hedging strategy that we may roll out. So
we'll be
might
curious.
Be kind of a fun little thing.
We'll be curious to see an update on that as well.
We're gonna call it the Longo Fund.
If you do that, I'm sure you'll have quite the influx of customers heading your way.
Exactly.
A veritable rush beating down your door.
All with deep voices, goatees, and large necks.
And darn handsome to boot, if I do say so myself.
Agreed.
All right, thank you for Mr. Sebas. And of course, if you want to learn more about what Mark has going on, then surf on over to optionpit.com. You can check out all the various strategies and new products and all the interesting coursework you guys have going on over there, as well as his little segment for Mr. Kramer recently that was such a hit.
You know what? And I was impressed that he actually went through. Like I said, he made a couple of small mistakes here, just from not being super familiar with the product. But what I wrote up was relatively complex. He understood it and was able to explain it, probably to a very large audience in a way that made the VIX actually seem interesting. Although he did go to the cliche, "Don't nix the VIX."
Well, that's talking Kramer. If he doesn't go to cliches and loud, obnoxious noises, he's not doing his job.
Yep.
But you can always tell with him when all of a sudden he's talking about something he's not really that well versed in, because all of a sudden you can tell when he's reading from a script and when he's just being Kramer. Yeah. And when he was doing your thing, he was definitely reading from a script.
Smart guy. And if he decided to learn about this, he would probably understand it pretty quickly.
I'm surprised he isn't more versed in it, to tell you the truth. You think this would be a popular subject for him on the show?
The reason being because his fund isn't allowed to trade options, and CNBC doesn't want to talk about options. So it's just been kind of the way he's been steered.
That's true. Well, thank you for that, Mr. Sebas. And of course, we discuss the full spectrum of volatility here, including what's coming up in the land of Euro. And Don, you might have the more difficult of the two prognostications this week, because the Eurozone is where all of the smoldering embers are lurking right now, ready to flare up at a moment's notice. So that factored in, what is your prognosis going forward for Euro Vol for the next week?
Well, here's what's interesting. I'm not so sure what the next week brings, but we spoke about the expiration that is taking place today in both the quarterly and the 1 month vol contract futures. But that said, let's look to the future, and let's look to the next front month, which will be January, and then look to the March, which will be the next quarterly. And since they are taking all of their pricing component really from simply options implied at the moment, they don't have any data points or any calculated realized volatility at the moment. It's interesting to see the January at 1436 and the March at 1561. So if nothing else, we have the options traders of the Euro options with that traditional premium of implied over realized, and whether it comes to pass that that's what the realized volatility will be remains to be seen. But that traditional spread that Chris Cole was talking about in equities earlier, and that was rather flat in equities, seems to be alive and well in the FX markets, because we do have substantially higher numbers looking at the January and the March than we do for the current settlement, which looks like it's going to be in the low to mid 11s.
All right. Thank you for that, Mr. Schlesinger. And right on the money, that is going to do it for this episode of Volatility Views. I want to thank, of course, our guest, Chris Cole, for coming on and joining us today, as well as Mr. Sebastian. And, of course, you, Don, for being my boon companion on this program, as always. And before we go, what is coming up in the land of Volex.us that may interest our listeners? How goes the foray into Bloomberg?
Well, it's imminent, and if we're not live today, then perhaps it's going to be Monday. But all the finishing touches have been put very fastidiously on all of our suite of screens and pages, and I dare say they look rather good. We've been vetting everything with our webmaster and with Bob Kraus, our CEO, and it's absolutely any day now. If it's not today, it surely will be the earlier part of next week, and we're excited about that.
All right, so our listeners can look forward to that. And of course, we want to thank everyone out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.